Hey, what's up, guys? So imagine this. Every single night inside the boring fluorescent-lit corridors of the Federal Reserve Bank in New York, something absolutely wild happens. Trillions of dollars quietly shuffle in and out of a place most Americans have never even heard of. This isn't some conspiracy theory or a secret vault. It's a financial tool so obscure that even many folks on Wall Street can't fully explain it. Yet, it has silently become one of the most powerful levers in global finance, holding a crazy amount of cash, over $2 trillion. And here's the kicker. This $2 trillion is essentially ghost money. It's vanished from the economy. It's creating a hidden crisis that's quietly messing with your mortgage rate, your 401k, and the stability of the entire market. I'm talking about the Reverse Repo Facility. Let's pull back the curtain on this bizarre money mystery. But first, a quick favor. If you love exploring the secret side of finance, the parts that really shape your money without you even realizing it, make sure you hit that like button and subscribe. It helps us dive deeper into stories just like this one. All right, let's get into the repo trap. To figure out this reverse repo thing, we gotta first understand the regular repo. Think of a repo as a high-stakes pawn shop for big financial institutions. Usually a money market fund loans cash to another institution, right? They get a safety guarantee, usually U.S. Treasury bonds, as collateral. The next day, the borrower buys the collateral back at a slightly higher price. That tiny difference is the interest. It's basically a super short-term loan that keeps the financial engine running smoothly. But what happens when everyone is suddenly rich and wants to lend, but nobody needs to borrow? That's where the reverse repo comes in. In this case, it's the Fed doing the borrowing. They take cash from the private institutions overnight, offering treasuries as collateral. It's basically a risk-free parking spot for cash, and the Fed pays them a tiny bit of interest, called the RRP rate. Harmless, right? Wrong. That's where it gets creepy. Fast forward to now, and that reverse repo facility has ballooned to over $2 trillion. That's not normal, folks. That's the financial equivalent of everyone trying to squeeze into the same tiny elevator at once. So, how did we get here? It goes back to the pandemic era. The Fed, in a massive effort to save the economy, unleashed a historic wave of quantitative easing, QE. They essentially printed money to buy bonds. This flooded the entire system with way too much cash, too much liquidity. Money market funds suddenly found themselves sitting on an ocean of money with literally nowhere safe to put it, because returns on short-term bonds were near zero. So, the Fed stepped in. They opened the reverse repo facility wider than ever, offering to take that excess cash overnight. It was supposed to be a temporary safety valve, but that valve turned into a massive black hole. Here's the hidden danger. When $2 trillion just sits there parked at the Fed, it's not circulating in the real economy. It's frozen liquidity. This is money that can't be loaned out to a small business, can't be spent on a new factory, and isn't being invested in innovation. It is like pulling $2 trillion out of the financial bloodstream and just locking it in a fancy Fed vault. And the irony is delicious. While the Fed is aggressively hiking interest rates to fight inflation, it is simultaneously paying billions per month in interest on all that parked cash, paid directly to huge financial players like BlackRock and JP Morgan. Who pays for that? Well, we do. The Fed's profits usually go to the U.S. Treasury. When the Fed pays this interest, it cuts its own earnings, which means less revenue for the government. In short, taxpayer money is indirectly subsidizing Wall Street's need for a risk-free parking space. This is the reverse repo trap. Too much money parked safely at the Fed actually destabilizes the broader economy. It incentivizes inactivity and punishes risk-taking, which is the exact opposite of what a healthy economy needs. The reverse repo facility isn't just storing money. It's storing financial tension, trillions of dollars waiting for the next big shift. What happens when that fear flips? What happens when those institutions decide to pull their money out all at once? That's when we enter chaotic territory. Imagine $1 trillion suddenly leaving the Fed's facility and flooding the market. It's like opening a massive floodgate all at once. Short-term funding markets could seize up. Interest rates could swing wildly. It could create a liquidity shock that would make the smaller 2019 repo crisis look like a fender bender. The system is now so reliant on this centralized safety net that it's become fragile. The Fed is caught in a bind. Move too fast. You flood the system and crash rates. Move too slow. You starve credit and the economy stagnates. And for you, the individual, here's the bottom line. This isn't just about a number on a balance sheet. It's why your cost of living feels so weird. Liquidity isn't flowing to Main Street. It's pooling safely on Wall Street. It's a silent wealth transfer, benefiting those who already own financial assets while eroding the purchasing power of your savings. The Reverse Repo Facility isn't a safety net. It's a mirror showing how distorted our monetary world has become. History shows that no institution can outsmart the consequences of its own complexity forever. When control mechanisms fail, systems built on confidence, not sound fundamentals, unravel fast. So when you see markets swinging without a clear reason, remember this hidden machinery. The crisis isn't just coming, it's already here, silently manipulating the flow of the world's most powerful currency. Stay aware, because understanding this system is the first step toward protecting yourself from it. That's the script. It's conversational, emphasizes the mystery and the personal impact, and includes the CTA right before the main discussion. Would you like me to adapt this script for a specific platform, like a TikTok short or a Twitter thread, focusing on the key takeaways?